So we're going to talk today a little bit about the federal student loan program and how it compares and contrasts to private lenders. So the federal student loan program is a behemoth of a program at this point. It was started by the federal government. They started getting into the student loan lending business back in the 90s, really back in the 90s. Started, but they became more and more involved in the student loan scene, and they came out with their direct loan program in right around 2010, and now they are the largest lender in the student loan space. The federal government's assets vary, but they consist anywhere from 30 to 50% of student loans as their main asset source. So that's a very large number. For many families, there are many benefits to the federal student loan program that could make them a better option than the private lending options. And we're going to go ahead and compare that right now. So when it comes to federal versus private loans, there's a few areas that have significant differences. The first is the application process as well as the interest rates. The second is the disbursement process. The third is the grace periods. The fourth are deferment and forbearance options, and that is a very large category. And then the fifth is repayment and forgiveness options, which is also quite a significant difference. So first, let's talk about the application process. The Parent Plus loan application and all the applications for federal student loans are found on studentaid.gov. Undergraduate students who have eligibility for Stafford loans just have to fill out the FAFSA on studentaid.gov. They don't actually have to put an application in. They automatically qualify for the undergraduate loans. But for both Parent Plus loans and for graduate student loans, the application is at studentaid.gov. That is the only place that you can find it. It will not come to you in the mail. It will not be through a flyer, nothing like that. It is the only place that you can fill out the federal student loan applications for Parent Plus loans and grad student loans is at studentaid.gov. Your private loan applications will depend on the lender. They will definitely be different, and there are a few specific differences. The Parent Plus and the grad school loan applications do credit checks, but they are more looking to make sure that you don't have significant bankruptcy history or default on your own student loans, and just that you have a decent credit score. They're not looking for something real specific to deny you. They're looking to have access to the largest group of people to have access to these student loans so that more students can enroll in college. Your private loan applications are going to look at your credit scores. They may have a specific number they're looking for. They're going to look at other debt that you have in your history, your debt to income ratio. They're going to look at your income. None of those things will specifically be looked at by the Parent Plus loan application, which only takes about 20 minutes. In an earlier video or in an upcoming video, we will actually walk you through that Parent Plus loan application. In the federal loan system, there's no co-signing. Each loan contract in the federal loan system only has one borrower on it. So for the undergraduate student loans, it would be the student borrower. For the Parent Plus loans, it would be one parent borrower, only one. And for the Grad Plus loans, it would again be the student borrower without any parents on the loans. In the private lending industry, you can have one borrower on the loan, but you can also have a co-signing situation where a student could be the borrower and a parent could co-sign. And then interest rates in the federal loan system, they're determined once a year. The student rates for undergraduate are generally lower, and they can be subsidized and unsubsidized rates, subsidized and unsubsidized loans. The Parent Plus loans have a higher rate and the Grad Plus loans have a higher rate. But as you'll see, as we move forward, there are more protections in the federal system so that the interest rate should not be the determining factor between the two lending options. So these protection and benefits, one of the ones that I do like to bring up is that in private loans, typically the loan does not pass with the borrower. So if the borrower were to pass away, the loan could still potentially be part of their estate and would have to be paid after death with estate proceeds. If there's a co-signing situation in a private loan, that could be even a more significant issue with a death situation, because if the student borrower dies, then or the parent borrower dies, depending on what's in the loan contract, it could cause the entire loan balance to become due to the surviving party. So you do need to look at your loan contracts very significantly in private loans to make sure that you understand what you're getting into and that you have coverage in case something of that nature should happen. In the federal loan system, if a borrower passes away, if a student passes away, or a parent plus borrower passes away, the loan is forgiven tax-free. Obviously, that's not something that we would want to happen, but also in the case of a student passing away, if the parent had parent plus loans on that student, those loans would also be forgiven tax-free, just the ones that are associated with the student who had passed. All right, so the second is the disbursement of the loans. So your parent plus loans, you fill out the application on studentaid.gov. Right there is where you put the school that the loan would be dispersed to for your student, and the U.S. Department of Education disperses the funds directly to the school. You can get reimbursement for overages, like if your student is living off campus and some of that money needs to go to their off-campus housing, you can get a reimbursement from the school, but the money gets dispersed directly from the U.S. Department of Education through that studentaid.gov application to the school. In private loan disbursement, it can work both ways. It can be dispersed directly to the schools, and in some cases it is, or it can be dispersed directly to the borrower, the parent or the student borrower, depending on who is the borrower, and then they would be a third party and they would have to pay it to the school. So it just depends on the lender in that case. All right, so let's look at grace periods. In both the federal and the private loan area, there's usually a 6-month grace period after school, after students have graduated. So after undergraduate school, for student graduates in both private and federal loans, they usually have a 6-month grace period so the student can get ready to pay back those loans. When it comes to federal loans and deferment, there is in-school deferment, and that would be for both the students and for the parents. The parents typically just check a box in the application. The students get automatic deferment. So you can defer the loans while you're in school. They call it either an in-school grace period or an in-school deferment, but it means that there's no requirement to make payments on principal and interest while the student is in school or for 6 months after they graduate. The same goes with Grad Plus loans, but this is also the case generally with most private loans. Obviously, you can always pay principal and interest while your student is in school, but you have the choice to defer it in both cases generally. Now, let's look at other deferment options. That's where it ends for private loans, but federal loans have many more deferment options and a ton of forbearance options as well. So first, we're going to look at deferment options. There are, in a deferment, it generally means that no payments are required to be made and interest does not accrue. So that's a big difference between deferment and forbearance. So in deferment, borrowers can apply for different types of deferment: cancer treatment deferment, economic hardship deferment, graduate fellowship deferment, military service and post-active duty student deferment, rehabilitation deferment, which would be like an inpatient rehab, drug rehab or other things, and an unemployment deferment. Most of those deferments are applied to the servicer, the company that is servicing your federal student loan, and you can get those deferments for up to 3 years. So you would be able to have no payments required or no interest generally accruing, and your loan would be in good standing if you applied for and were accepted into these deferments for about up to 3 years. And under the economic hardship deferment, that would be like if it was a welfare recipient who was not having a high enough income to pay their student loans back, other low income levels, and also Peace Corps qualifies for that economic hardship deferment. Now, for forbearance options, there's 2 types of forbearance options. Generally, with forbearance, you are required to pay the interest or even make smaller payments if you can, but no principal payments are required. Now, there are situations where you can also defer that interest, but it may accrue and capitalize into your principal balance after your forbearance period is over. So let's talk about general forbearance. Your general forbearance is granted in 12-month timeframes for up to 3 years, similar to the deferments. And these can be for financial difficulties, medical expenses, changes in employment, or other acceptable reasons to the servicer. And some general forbearance periods might include, like, if a person is not only changing employments, but possibly moving across the country, they could ask their servicer for a forbearance for a few months so that they could get settled into their new job, or to find a new job, they could ask for up to 12 months. And they'll are generally granted 12 months at a time, as I said before, up to 3 years. Then your mandatory forbearances are a little bit different. And they can be circumstances such as if you are participating in an AmeriCorps situation, if you have a medical or a dental internship or residency, you can request and get a mandatory forbearance. If you have National Guard duty, if you are going for teacher loan forgiveness and you don't want to be paying on your other student loans until you get finished with your teacher loan forgiveness course of action, or if you have a very high student loan debt burden that's more than 20% of your income, you can also apply for the mandatory forbearance. And again, they are granted at 12 months at a time. So then let's go on. I do want to reiterate on that last slide that those forbearances and deferments are generally only options in the federal loan system and not the private loan system. So that is quite a significant benefit. Now, some private lenders may have some economic hardship options, but nowhere near the system of benefits that the federal loan system has built into it. Now, also, the federal loan system has two different repayment options, whereas the private loan system generally will just have the one option. So your repayment options in the federal loan system are called standard and IDR, which stands for income-driven repayment plans. So in the federal loan system, the standard option is based on the balance of your loan. So the higher the balance of your loan, the more money you would pay to get that loan paid off in a specific term. So if your loan was for 10 years, if your standard loan term was for 10 years, they would take the balance of your loan and divide it up over that 10-year time frame, and you would make equal payments all along that 10-year time frame until the loan was paid off. So in the standard repayment option, you pay off the entire balance of the loan. This is not the case in the income-driven repayment option. But I would like to point out that the private loan repayment options are most typically standard. And in the federal and the private loan arena, you would have different levels of terms. So you could pay for 10 years, 15 years, 20 years, 25 years, or even 30 years. Definitely in the federal loan, it would depend upon the lender in the private loan industry as to whether or not you would have a 30-year option. But in the federal loan industry, if you have a very high balance on your loan, over $100,000, you could get up to a 30-year term, which would make your payments less, but you would still be paying off the loan in that term. The income-driven repayment plans are different. The income-driven repayment plans work on your monthly income. So it doesn't have anything to do with the balance of your loan. The balance of your loan still exists, but your income-driven repayment plans calculate what your monthly income is, and then they deduct your family size, and which is like a cost of living deduction, and you pay on a percentage of that monthly income. So your payments on an income-driven repayment plan are always going to be less than your standard loan payments, and your income-driven repayment plans, which are only available in the federal loan system, are going to be tied to what's called forgiveness plans. I'm going to quickly go over those. So in the federal loan system, you have two different main forgiveness options that are tied to those income-driven repayment plans. The first is public service loan forgiveness, where you work for an employer for 10 years that is in public service, and then you would get the balance of whatever you haven't paid after that 10-year time frame of your loan forgiven tax-free. And then the long-term forgiveness is also tied to the income-driven repayment plans, but you would pay for a considerably longer period of time, 20 or 25 years, depending on your loan, and then you would get the balance of that forgiven. And right now that's tax-free. In the future, there may be a tax obligation to that longer-term forgiveness. The benefit of the public service loan forgiveness program is that the government is trying to encourage people into an area and areas that they feel might provide them with lower income, but is a public service for the country. And that's why the trade-off is that they would get their loan, a portion of their loans forgiven within that 10-year time frame. The longer term forgiveness is not determined on what industry you work in. It can be in any industry, but you have to pay your loans for a considerably longer period of time before you get any forgiveness. There are other federally available forgiveness options for military service, medical service in rural areas, as well as Indian reservations. The National Institutes of Health have many programs where they will help pay off certain portions of loans. Your Peace Corps and AmeriCorps also have specific options where they will pay down some of the federal loan balance when you're serving in those areas. So in the federal system, you have many, many forgiveness options that are available. Your private loan forgiveness options are not industry-wide. There may be some forgiveness options that are available for private loans specifically, like in the teaching area, but they wouldn't be involved with public service loan forgiveness or any of the long-term forgiveness programs. They might be something that an employer offers, and that could go towards federal or private loans, but they would not necessarily be something that would be industry-wide.